The recapitalization policy by the Central Bank of Nigeria is expected to have significant implications for the Nigerian banking sector, investors, and the wider economy, with potential benefits and challenges to be navigated by stakeholders. Now, Praise Ihensekhien, the head of investment and research at Meristem Securities Limited, made a statement regarding the recent recapitalization policy of the CBN, and she is joining us today on the show to help us look into this properly. Praise Ihensekhien, thank you so much for joining us on Business Edge.
Thank you for having me.
So you just suggested that the recapitalization policy may lead to a shift in preference among shareholders and investors towards bank stocks. Can you elaborate on this?
Thank you for the question. That statement was coming from, an expectation of the broader market performance and investor sentiment and what's going to happen with the investors. Remember that we are in a monetary policy regime, that is very aggressive wants to hike rates. That means that the fixed income market is looking more positive now for investors. However, we are also having investors are still going to look to the equities markets, definitely. And then for investors to come to the equities markets, they're going to favor stocks that are fundamentally sound and they're justified by their fundamental performance. So most of these stocks, definitely, you would see investors tilting towards looking into the banking sector. And then, of course, the recapitalization exercise also provides another means for investors that are interested in coming into the banking sector to also, fulfill their interests. We're likely going to see companies do rights issues. We're likely going to see mergers and acquisitions happen within the industry within this period. And we know that these corporate actions are definitely expected to boost performance of the banking sector and, of course, pique investors' interest. Remember when MTN came to the market, I think it was 2020, 2021, I'm not exactly sure right now, to do a public offer. And that, opened the way for more investors that were not, captured in the equities market before to come in. So that's likely what's going to happen again this time around. If a company in the banking sector does a public offer, that would, spur more investors, more retail investors, more institutional investors to come into the equities market and, of course, invest in the banking sector.
Okay, you've talked about investors. Let's look at the shareholders. We know that recapitalization will see banks get more liquidity. So what about these shareholders? Will there be benefits for them or probably losses?
Well, I mean, the liquidity for banks and when in terms of increasing their capital base, this is likely definitely to strengthen their ability to increase their asset base, raise more loans, and just invest more capital into growing their business, basically. So this definitely will trickle down to shareholders in that aspect. And then for investors in the equities market, we might begin to expect more dividends from these companies because, more capital is accessible to them. They are able to have more access to sweat, and then that should begin to trickle down to more dividends in the coming periods. But remember that we have 24 months for the banks to achieve this recapitalization exercise. So it's not something that will just happen immediately. It's going to be a gradual process to that.
So that's going to be a big challenge, looking at the time frame with which the bank will need to raise the needed capital. Now, we understand that recapitalization comes with certain challenges. One of the things you mentioned is the time frame, if that will be adequate enough. There's also the issue around cost, meaning raising capital can be expensive for some banks, especially if they need to issue new shares. So won't this whittle down the ownership position of existing shareholders and potentially decrease their returns?
When you're increasing your capital, increasing your share base, and remember that the retained earnings is not part of this, what they can use. Retained earnings is not part of what they can use for this share capital exercise, raising capital. So it's more of the share capital and the share premium. And so when they're expanding that base, definitely the next thing that happens is that investors begin to lose some of the earnings per share is diluted in a way. But then, like we said, most banks and most of the banks, especially the international banks that have international licenses and national licenses, the likelihood of what's going to be expected is that we are going to see share capital, the earnings per share return to higher levels, because while the earnings per share on the share the number of shares that they have is going to increase, which should reduce earnings per share, there should be an increase from the revenue side of things and from the net income side, because the banks are going to either invest this capital, and find ways to make sure this capital generates returns. So on the net, we're not likely to see that dilution of earnings per share because of the expectation that banks are going to be able to utilize this capital rightly. This has happened before. This recapitalization exercise has happened before. We know prior to now in 2004, we had that bank recapitalization exercise happen. And of course, the result of that was that there was also increased performance of banks. There were some lags here and there and some loopholes that hopefully this time around doesn't occur. But then we should see that increase in earnings per share, which happened the last time also with the banks when the last recapitalization exercise happened.
And you think they'll be able to meet the targets within the frame handed out to them just in about 4 months?
24 months.
Okay, actually. 24 months.
24, yes, 24. Okay. They have 2 years.
Okay.
To meet the time frame. So yeah, that 24 months. I think banks should be able to raise capital in 24 months. A lot of them have actually come out already. Access Bank, GTCO have already, given indication of they are going to raise capital even within this year. And we expect that some more banks, other banks will also come up. Remember that they have options. They have public offer. They can do mergers and acquisitions. They can do rights issues. So there are different options. They can even do private placements, to be able to raise this capital. So they have options of what to do to be able to raise capital. But the CBN was very particular in stating that they cannot use bonus issues to raise capital and then some other means. So the options that banks have, and within the 24 months frame, which is 2 years, yeah, they should be able to meet it.
Well, in none of the options available and the possibility of these banks meeting the targets, some bankers have expressed opposition to the CBN's decision to exclude retained earnings from the share capital calculation in the recapitalization guidelines. What's your take on that?
On one side, you can understand both sides, really. On one side, on the CBN side, excluding retained earnings might not be far-fetched. Let's look at the fact that some of these banks have recorded significant FX gains. Significant with the depreciation of Naira that has occurred over time, banks have recorded significant FX gains, and this has definitely boosted their retained earnings position. So this, some of the what is involved in retained earnings, CBN might argue that some of it is not on cash basis, some of it is tied to some assets. So on the CBN side, it's kind of justified to say, let's make sure that the capital that is being raised is both from the share capital and the share premium. Also, the banks really cannot compete with even some West African companies and from some West African countries. Banks in Nigeria cannot compete with banks in South Africa. The name of the bank in South Africa is missing me right now. But that particular bank, if you add up all the capital of all the banks in Nigeria in dollars, it cannot meet up to what that banks in South Africa banks the share capital base of that bank is. So I think I understand the CBN's point of saying, let's make sure that we come from a place of using just the share capital and share premium to ensure that banks can sufficiently compete with other banks in Africa and, of course, other counterparts outside Africa. But then on the side of the bankers too, the question is CBN regulates their ability to give dividends, and over the years you won't typically see a bank that will have a dividend yield of say 20%. Even a dividend per share, dividend payout ratio. They don't have so much buffer. Their dividend payout ratio is usually between 20 to 30%. So if the CBN has been regulating that dividend per share over the years, what was the point? I think their own pain point is, what was the point of regulating their dividends that they can pay out to their shareholders so much and then not being able to add that to their share capital when they want to raise capital? Because a lot of the banks would have been excluded from this need to raise capital if the retained earnings was involved. The first time that the CBN governor mentioned this last year, some analysis were done, and I promise you that a lot of people included the retained earnings. A lot of us analysts, we included the retained earnings in the calculation of the shares. So we didn't include some of the tier 1 banks because we didn't expect that they would need to raise capital. But with the fact that the retained earnings is not going to be included, it's quite clear that, the CBN might have a point, might just need to know that I don't think Nigeria is the first country to have to raise capital without including the retained earnings. We've seen that in some other African countries also happen. I think the point of the CBN is just to be able to strengthen the banks to withstand any shocks that might come up in the economy, and also to be able to enable them compete favorably with other countries. Remember also that they're trying to achieve a $1 trillion economy. A $1 trillion economy, to be able to achieve that, your banks need to actually sit tight to be able to give that credit to the system that would help achieve that $1 trillion economy.
Interesting. Before I let you go, Praise, quickly, two things. You've talked about the $1 trillion economy and how possible these can be achieved, most especially in the area of this recapitalization policy. But don't you think that issues around inflation could put a dent or slow down this process? And how do you think it will also affect Nigeria's borrowing capacity?
The inflationary pressures that we face in Nigeria are legendary. I think they've been significantly discussed in different platforms. And the monetary authorities, even the fiscal authorities, I think they recognize that the inflationary pressures can hamper their ability to achieve the $1 trillion economy. That's why we are seeing so much effort from the CBN to try to bring down inflation as much as possible. I mean, of course, the CBN can only do so much, because there's also the part of the fiscal authority waking up and tackling insecurity and tackling some other major issues that can help to combat inflation in Nigeria. So if you put this together and everybody, acts in the way they're supposed to act, hopefully we would see inflation come to a comfort level, because you have to have some level of inflation in your economy for your economy to grow. That inflation is not necessarily bad in entirety, but it's bad when, at the point where we are recording food inflation of about 37%. That's where, there's a little bit of an issue. You have to have some level of inflation in your economy to be able to grow the economy, to be able to grow your GDP. So inflation itself is not entirely bad. The level it is, where it is now is the issue. And of course, the CBN has been doing a lot. Where inflation is going to get to in the long term is hugely dependent on what the fiscal policy do. Of course, this is going to effectively affect every other thing that happens in the economy. It's going to affect the ability to grow the economy, and of course, credits to the real sector in the economy would continue to be tight if the inflationary pressures remain high. Because remember that if inflationary pressures remain high, the CBN is going to continue to increase their interest rates, and if CBN continues to increase their interest rates, credits to the real economy, to the manufacturing sectors and all that might be limited, and that will definitely impact growth and the ability to achieve the $1 trillion economy. So curbing inflation and the exchange rate challenges we have in Nigeria are very, very important to eventually achieving the roadmap that the CBN and the fiscal authorities are trying to paint.
Okay. Praise Ihensekhien, Head of Investment and Research at Meristem Securities Limited. Thank you so much for your time.
Thank you for having me.